And I think uncertainty has been the reason that it's been so challenging to get any exits done out of this region.
Yeah.
When you have large multinational corporations who are usually the buyers in a trade sale, and they're focusing on their core businesses and organic growth because they're worried that they don't have the confidence to go and start buying up new companies to supplement their businesses.
Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, serial founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave.
Hey, excited to have you back on the show and in person now.
Yeah, well, likewise, I've seen this room many times on the recent episode. Great to be here. Yeah.
I'm glad to have you on the show because I think there's a lot of questions about Southeast Asia, the legal scene, and people really enjoyed your episode last time around talking about startup law and your perspective as a partner at Gunderson. I'd love for you to introduce yourself.
Sure. Yeah. So I guess for those who don't know me, my name's David. I'm a partner at Gunderson Dettmer. We're a law firm based globally, but grew out of Silicon Valley about 25 to 30 years ago. And we specialize in representing what we call the innovation economy. So it's historically it used to be companies that develop technology. I think nowadays, because of the way that technology has become systemic in just about every business in the world, it's companies that are reliant on technology as well as those that propagate it. We have offices in a number of states in the US, internationally, Beijing, Singapore, and Asia, and office in Brazil that covers LATAM. I relocated here about six and a half years ago. So my practice is almost exclusively focused on the venture capital and startup scene. Represent at any given point maybe 50 to 70 startups. Not all of them are active year on year, but when they do fundraisings, that's usually when we're most involved. But on the company side, anything that's kind of day-to-day governance related, certainly anything commercial contract related, and also just advising the board of directors on their fiduciary obligations, helping companies navigate equity planning, investor relations, what they can and cannot do without shareholder approval. So that's largely on the company side. And obviously, if they get to a point where they can have either a buy side acquisition or a sell side exit, that's something that we guide them on as well.
Awesome.
Then on the investor side, mostly just your typical venture rounds into new portfolios.
Great. Thanks for sharing. And I think you and I were discussing a little bit about what has happened between the last episode that's available in the podcast library and today. And I think one interesting thing was that when we did our last episode, it was in the midst of the Asia tech winter. And so we're talking about how to pick a good lawyer and some of the key things that happen. And today, which is about almost 2 years on, and I was just saying that it felt like spring was back for Asia, but with the stuff that's happened effectively in March and April of 2025, it feels like spring is on hold again with the Trump tariffs, with the E-Fishery Scandal. How do you feel about what I'm saying?
Yeah, I think that's spot on. When we last spoke in 23, obviously this business is cyclical like any other, right? And so 21, 22 post-COVID year, activity just off the charts, rapid fire term sheets being issued left and right, large rounds, fairly modest level of due diligence, investors competing for allocations. Then we hit second half of 22 or most of 23. And I would say the first half of 24 was what everybody colloquially refers to as the funding winter, right? VCs taking a step back, very little new deal activity, focusing on how do we support our existing portfolios? How do we identify the ones that we should continue to stake versus the ones that maybe you may consider writing off? So I think that was a period where very few exits, very little new deal activity. And that was the last time that we spoke. Now, during that period, I think what a lot of startups were forced to do, and probably I always thought it was great from a long-term perspective for this region, focused on unit economics, focused on monetization, getting to break even if it's at the cost of growth. Let's hit the brakes a bit on expansion at all costs. Let's focus on the markets that we understand, the customers that we understand. let's roll out products and see how, rather than just building a pipeline of products, and get to financial sustainability much quicker than we otherwise would. And the optimism, I think back then was, okay, a lot of these companies are refocusing on getting the profitability. What that means is it will unlock different sources of capital that your traditional VC-backed loss incurring cash burning startup wouldn't have for many years. So the moment you can become profitable or flip profitable at will, that unlocks access to venture debt, private credit, perhaps small cap PE money. And the idea was, okay, given the gap in growth funding in this region, which may not come back for a number of years, in the early stages, you can still rely on traditional venture capital. As you get to the scaling and growth stages, because you're profitable or can flip profitable, you can start to look at other sources of capital, like the ones I just mentioned.
Yeah.
And I think the hope was, okay, 22 was when everybody was trying to figure out what to do next. 23 was a period of actually executing on pretty dramatic and quick shift, right, in a growth versus monetization dynamic. And then 24 was when VCs would start regaining confidence and start, number one, realizing which are the portfolios they want to continue to support, and start earmarking more money for new deployment. So we talked about like the combination of factors that leads to deal activity. VCs have a fund mandate to deploy, right? Tremendous amounts of dry powder from funds that were announced and closed or interim closed in 21, 22, and 23. Companies, despite optimizing for financial sustainability, companies starting to reach the end of their cash runways in 24 and 25. Hopefully interest rates gradually continue to be brought down. And I think another thing we talk about is the AI, to focus on utilizing AI tools, right, as a source to not only build better products for customers, but also to reduce costs and optimize internally. So all those things were leading, I think, to what you refer to as an easing of the fund winter or a spring. Personally saw more activity, I think, in the second half of 24 than I did in the 12 or 18 months combined preceding that. And 25 Q1 was all looking pretty good. And there were a couple exits in 24. I had a couple more clients that are in the process of an exit starting in Q1 this year. A lot of term sheets being issued. We can talk more about the structure and nature of those term sheets. Very different from 21 and 22, but at least they were happening.
Yeah. And I think that's the interesting part, was that I really was right alongside with you, because I would say that in Q4 of 2024, and I would say even January and February of this year, 2025, it felt like there was an upswing where it felt like the startups had figured it out. So those that survived were able to figure out unit economics. There's still some dry powder left in the funds that could top up for the best companies. And I think two things happened that I'd love to get your point of view on, right? Obviously. So one, of course, is the E-Fishery implosion, where accusations of accounting fraud and so forth. That's one. And the second, of course, is the Trump tariffs in Southeast Asia, ranging from 30 to 45% across like Indonesia and Vietnam. But maybe we'll zoom in on fishery first. What was your sense of the E-Fishery? Less about what happened at E-Fishery, but more like how did you first hear the news, and how do you think people in the legal profession and your circles digested that set of news?
Yeah, I won't get too into detail about how I first heard the news, because I probably heard about it quite early on. I have some clients that were involved. But I think it was let's just call it financial irregularities and mismanagement. Fishery was a bit of a FTX Theranos type moment in this market, just because of the scale of the fraud. But I think there had been multiple instances of mismanagement and irregularities in the years leading up to it. I don't think it's something that is unique, certainly, to Southeast Asia. It's the unfortunate optic, I think, that we're facing here is there's fraud in every market. Right? There's bad behavior in every market, especially the emerging ones. You look at Middle East, North Africa, India, even the US, right? Like the ones I just mentioned, FTX and Theranos, those are US companies. But I think the issue with Southeast Asia is we don't really have a track record of successful exits to offset it. And so when you're an ecosystem that has been struggling to generate returns, and you keep getting headlines of things like E-Fishery, that's a very bad combination. And that's a very, and it wasn't Southeast Asia. I think it was always going to be a struggle to compete as a region with other large venture markets like China and India. I never really understood the comparison of, hey, the Asian countries or the 6 major economies of Southeast Asia being comparable to an India or a China. There's just too much fragmentation, political differences, cultural differences. It's the population size and the GDP you could put that up on a graph and it starts to look a little bit like India, but it's not. It's much harder to expand from Indonesia to Malaysia to the Philippines than it is to expand from one part of India to another. And so it was already going to be a challenging sell to global investors to continue deploying the way they did in 21 and 22 in this region. But the timing of the funding winter, the slowdown in capital markets, coupled with the fact that there's all these bad stories out there, that's really tough to overcome. And I think it's caused, we can talk a little bit more, the repercussions of an E-Fish type event, but it's nothing that hasn't already been happening.
But yeah, now there are bonus rounds of due diligence that are happening, which sounds so painful. And I think that's the interesting dynamic, right? Which is there's always that balance between too little due diligence, which I think some people may argue allowed for e-fishery scandals to develop, I think on one side, and obviously there's too much due diligence or too painful due diligence. I'm just curious, like you said, you're noticing a change in the due diligence patterns that VCs and investors are doing. Could you share a little bit more about what those differences are?
Yeah, I think that on the business side, a lot more commercial due diligence. And that it used to be you could get to a term sheet pretty quickly with minimal diligence. And then once you sign a term sheet, it's a rush to get the deal closed. And we used to estimate around 6 to 8 weeks for a traditional equity round. Nowadays, easily a couple months before that term sheet even gets issued. And then by the time it does get issued, its legal due diligence and commercial due diligence continue to run in parallel. And that can still take 2, 3, sometimes 4 months to get done. And as a lawyer who's negotiating the principal transaction documents, your subscription agreement, shareholders agreement, it's hard to get to a point where you can start seeking internal approvals, other hoops that you have to jump through once you finalize with the lead investor. And the reason for that is because findings keep coming out of due diligence and then the documents keep getting supplemented. So that, I think that delay in transaction, as a timeline gets stretched out, transaction costs continue to increase. And I think a lot of investors are no longer comfortable completely conducting the business side of the diligence exercise in-house, bringing in professional accounting firms to help out. And that's also it.
Yeah. And I think a lot of the immediate feedback was like, we need to do more forensic accounting to pierce like any opacity by bad faith actors. But of course, I think what's happening is that everybody's getting forensic accounting as part of the due diligence. And I have been on both sides of the transaction. I've been a person doing the due diligence on the startup, and I've also been a startup going through due diligence. And it's not an easy process for sure. It's a lot of paperwork. And I think your business can actually slow down to a crawl because you're so busy generating documentation based on the compliance requirements. But I think what's interesting is that we're also seeing some changes as well for the transactions as well. I think we're seeing, for example, convertible notes being very much part of the mix. And I think we're also seeing ESG, like terms and compliance also being injected as part of the funding process. Could you share your thoughts on those two ways of changes that you've seen as well?
Sure. Yeah. So I think the convertible notes, the feature of a convertible note is it's senior to all equity until it converts. It is usually unsecured, so it's going to be subordinated to any secured debt instruments. That includes venture debt, includes most traditional bank debt. But as with most debt instruments, there is a maturity, because it's convertible, there's a maturity date, there's interest that accrues, some other features. You have some pretty stringent covenants. Usually convertible notes, unlike venture debt and traditional bank debt, you don't get into things like debt equity ratio maintenance and minimum cash balance maintenance, but there may be some covenants, right? And then there's a definite default. So if you breach any terms, if you fail to make payment at maturity, the events of default are pretty draconian against the company. I think 23, 24, a lot of companies relied on convertible note. There's a few reasons for that, right? It's a better instrument for investors. It's a liability, so it increases your cost of borrowing, but it, from an investor's perspective, it's automatically senior to all equity.
Right.
Immediately, I don't have to go through the song and dance of negotiating all these downside protections because I can just rely on the fact that I'm already senior.
Right.
But notes usually have pretty short maturity dates.
Yeah.
And so 2 years, 3 years, the expectation is, hey, this is a bridge instrument to get through a very challenging period of time, but you eventually have to raise a qualified equity financing, and then we will convert the notes. Because of how long this winter has stretched on, I think a lot of the notes that were put in place back in end of 22, let's just say, are actually coming due. And as a note holder, so compared to a preferred lead investor, you have a lot more leverage as that maturity date starts to get closer and closer to get what you want out of the company. Preferred equity, you might have negotiated for some exit rights, right? In this region, it's not unusual to see some obligation to go hire a banker to run a process or to find a sale, and it's all best efforts. And so not too many hard obligations as an equity holder to force an exit, and as an equity holder, your primary leverage over the company is through your negative controls. The company cannot do things on a long list of reserve matters without your approval, as long as you control those matters. But sometimes these funds have a director on the board, so there's got to be a bit of a delicate balance between what is my obligation as a fiduciary to all shareholders by virtue of my board seat versus what is my obligation as a fiduciary to my fund to get the best result for my investment. And so there's, in some sense, large preferred shareholders on the cap tables of startups don't actually have that much leverage to force things to happen, right? But as a note holder, you have tremendous leverage because at maturity, you could basically call the cash on the company. Right? And many times that either means wiping out the equity or putting the company at least in a very precarious position. And you take that money from your note and you can walk, right? The principal and interest, that's yours. It's senior to everyone else. There's no fiduciary obligation to look after the interests of other shareholders, right? And I think a lot of funds that had these notes in place are realizing, oh, actually, as they're coming due, we can ask for a lot of things that we wouldn't have been able to ask for as a preferred shareholder. So even new investments that are happening in this region, I think, at least in my experience, a lot of them are happening through notes because investors are recognizing, like you said, hey, this might be a very cold spring, right? It might, even if things start to progress upwards, it's not going to be a J curve recovery, and it will take a while. So why don't we just continue to invest in notes, and that'll buy us another 2-3 years before they mature. It'll get the company the capital they need, but we will be in a more comfortable position from the perspective of an investor that's trying to protect downside.
Yeah. And I think that's an interesting piece because I think convertible notes have historically been seen as a faster way to raise, more straightforward. And I think there's a little bit more sophistication or learning by both sides about the virtues and the downsides of convertible notes. I think for founders, it would be, yes, it's easier to raise in the short term. There is that dynamic where you have to pay off at the end of that period. So it creates like a negotiation, I don't know, inflection point or crisis. I think you just have to be very mindful about that. And I think for investors, convertible look even better now because if there is a downside scenario, you have a lot more control than you would have had if it was, equity.
Yeah.
When you look at the future as well, I think there's also a big wave towards like small cap private equity or outcomes that are not necessarily venture scale, perhaps tackling like the Indonesia or Vietnamese rising middle class. For those kind of outcomes, do you see the instrumentation of the legal side shaping up? Because I was talking to somebody recently and then they were like, oh, maybe there should be an equity agreement, but then there's a clause that after 5 years, you can pull the money out. So there's all kinds of like conversations about what happens if the outcome is good, but not great. So I'm just curious what you're seeing.
As in like a redemption.
Yeah, exactly. Exactly, yeah.
I think the danger of any redemption feature for equity is, number one, as an investor, it doesn't necessarily get you the protection that you want because it's going to be pari passu with every other equity holder in your class, at least, right? So you can't do a partial redemption of the Series B and not allow other Series B investors to redeem their portion. And to the extent the company ever raises more equity, it's usually going to be larger check sizes coming in that may stack on top of yours or at least be on par with you.
Yeah.
redemption is also subject to a lot of solvency requirements, right? So you can't actually, in Singapore under the Companies Act, you can't, there are solvency requirements to do any kind of share buyback by the company. So if the redemption is going to drive the company into insolvency or render the company functionally insolvent, it's not going to be permitted, or it's not going to be fully redeemable. So it's just a lot more uncertainty around the enforceability of a redemption provision for equity. That's different for debt instruments.
Yeah, makes sense. And I think that the other part that we talked about is that there's a lot more ESG compliance requirements that's, I think, emerged over the past 1 to 2 years. What's going on there, and how do you see that shaping up further?
So I think when we talk about ESG, to me, it's usually the G that people focus on. And I think in recent years,
In governance.
right? So having there are pretty large sets of standards out there put forth by institutions like IFC, ADB, and that's usually a starting point, I think, for a lot of funds that require ESG policies. They can always look to that and layer on or redact. But for I think the consequence for founders is a lot of those ESG policies are meant more for large established institutions that run load machines, have departments that handle these. For example, like HR is a very obvious one, right?
Yeah.
What are certain employee policies that you need to have in place to comply with various jurisdictions and their labor requirements? But on top of that, what are standards that institutions want to see applied globally? Those may not actually be required by local labor law, but it's a standard that they want you to implement everywhere where you have a presence. And it's just for startups that are sitting on a few $1 million in the bank and trying to do what they're trying to fulfill their mandate of break even and at the same time scale. It's where do you find the internal resources to focus on complying with the ESG requirements that your fund may require? That's very challenging. And on top of that, in recent years, and this was something post, let's just say Russia, Ukraine, sanctions and anti-money laundering, and for many years now, corrupt practices, right? Corruption, corrupt practices, import-export control. These are also regulations that stack on top of what people usually think about when they think about typical ESG, right? And so regulatory compliance, and these are regulations that are not specific to regulated industries. If you're a regulated industry, if you're operating in a regulated sector, you're a fintech, you're direct to consumer, you're life sciences, there's additional regulations on top of that, right? Maybe around foreign ownership, maybe around other things. So if you think about just like the bodies of regulations that have become more and more stringent and applicable to startups, we get into AI, data privacy, right? You have IP, and so it's a lot of internal expense and resource, both human and cash, that is going to be needed to be allocated toward just internal compliance. And when you have policies that are not even strictly regulatory requirements, they're just standards on top of that. It's an entire another body of compliance. So I see these policies, sometimes investors just across the board, it's a fund mandate, it's in their LP agreement, they need to have it. I understand that. But when you drop it into the shareholder agreement as a covenant, as a founder, I would say if there's not at least some commercially reasonable or practicable standard or qualifier in there, you're going to probably immediately be in breach, which is not a good thing, right?
Yeah, that's fine. Yeah.
And in the subscription agreement, you have to deliver warranties.
Right.
You may have to deliver indemnity. Sometimes it's joint and several between you and the company. So the founders are backstopping it, especially in the early stages. It's not unusual to see founders backstopping these warranties. So if you're a Series Seed or A stage company and you're raising $2 million, $5 million, and you're personally backstopping these warranties, and there's a warranty in there around ESG, you should be very careful before you just go and agree to it. Questionable whether any fund would really actually enforce that against the company or the founder. That's their own investment they're destroying in some sense. But warranties are not always, they're not always qualified by commercially reasonable. It's just a flat warranty or a clean, we call it a clean rep. You hereby warrant that at the closing, you are compliant with, it doesn't need to show up as 40 pages of material. It's just one line that says you're in compliance with ESG standards. And then you see a definition of ESG standards. It includes a list of global standards. And then when you look at the list of global standards, you realize each of these are 100 pages long. Right? So I think it's just something to be mindful of, right? And I think it's also something as an investor, you need to be a little bit flexible on, because the reality is if you have your fund standards, the next investor also has their fund standards. And then after that have their fund standards. And do you really want, at some point, this company, yeah, okay, they're a Series B or C company, they've got resources, but they have to comply with 4 different sets of standards. Now, a lot of them might be overlapping, but do you really want to be the one that sets the tone for every a future investor to say, hey, these guys got their standards in there, and therefore we have a right to have ours alongside them?
Yeah, and I think it's a tricky time period. And obviously, I think everybody wants to see more ESG, right? Environment, social, and governance. But of course, I think the tricky part is the compliance side of it is the expensive part of it. And I think moving to the next stage as well, we said that we'll talk a little bit about the reason why we think it's a cold spring is because the recent set of tariffs on like Southeast Asia, like Vietnam, Indonesia, is going to cause, I think, some economic distress, I think, for these export-led economies as well. And I think, I'm still thinking them through because obviously if you're like a SaaS company selling to America, you're not necessarily impacted because these are tariffs on goods rather than services. But still, what is the effect? What is the second order effect? Those are the kind of questions that I'm still thinking through.
Yeah. Yeah, I think maybe as a startup, just the clients that I work with, I hope that they're less affected by these than, for example, your typical cross-border multinational corporation, right? That actually is affected by supply chain disruptions, right? By the ability to fundraise in capital markets because of volatility. I think startups hopefully are not as exposed, at least immediately. You're right. I think if the typical tech startup is probably not going around with trying to ship containers of raw materials or goods to or from the US. And it seems like these tariffs so far does not extend to the traditional, for example, SaaS, right? Like services. And I think nevertheless, it's going to cause uncertainty globally, right? And I think uncertainty has been the reason that it's been so challenging to get any exits done out of this region.
Yeah.
When you have large multinational corporations who are usually the buyers in a trade sale, and they're focusing on their core businesses and organic growth, because they're worried that they don't have the confidence to go and start buying up new companies to supplement their businesses. That's a pretty big freeze on kind of M&A activity, right, for startups. In the same vein, I think when you see capital markets volatility, I think the VIX today was like 50 points, right? You can't price an IPO in this environment. And so that also significant. And when you have these IPOs that are in the pipeline and you have a period of volatility, they hit the pause button and it may be 3, 4, 6 months before they can really get back to where they were again. I think probably for more relevant for the startups here that are not in the business of importing and exporting goods between the US and this region, the impact is really going to come from the global uncertainty around pulling the trigger on any kind of exit. And I think that's something that's already been pretty difficult for us here. It feels like it's not going to get any better, at least.
Yeah. Yeah. And I think that's going to be an interesting set of challenges they have. I'm just curious as a legal partner, obviously you're working across the whole ecosystem. Do you see any trends or changes that you think are interesting for folks?
Yeah, I think in at least up until a few weeks ago, let's see what the case is going forward. There were more global investors coming back into the region. I think there were also more startups here that had gotten to a point where they could start executing on a more global go-to-market strategy. And that's very important to attract foreign capital. I don't know if that will be the case necessarily. It may not be the upward trend that we were hoping for in 2025, which means there will be more reliance on regional venture capital for at least early stage startups. To me, Indonesia has been quiet, which I think it's not just because of E-Fishery. It was also one of the most heavily invested and oftentimes at inflated valuations regions in 21 and 22. But if you talk to most US investors and you talk about Southeast Asia, everybody knows Indonesia. There's not as much of a focus on some of the neighboring countries because of the smaller TAMs. And I think let's just call it the overinvestment in Indonesia back in 21 and 22, followed by the underwhelming results, has caused Indonesia to be a difficult place for large global investors to continue investing into. Philippines is very active for me personally. I think I do I've seen more deal flow there than I have seen, not really counting, I don't count Singapore, because Singapore is where all companies are based, incorporated here, right? Operationally, where the ones that are in the Philippines seem to be getting quite some traction, and perhaps it's because they were not as overinvested back in 21 and 20.
I think there's an interesting piece, right? Because what we're talking about is like the fundamental economy versus were they overinvested in the past in the bull cycle, and now that when someone in the bear cycle, what is the right level of appropriate investor interest for sure? And I think the Philippines, I agree with you, continues to be of strong interest. I think because they are strongly natively proficient in English, which makes the market, I think, a lot more understandable to the American growth investor for exploration. And obviously there's a strong Filipino diaspora group in the US as well, which helps, I think, bridge both the talent and investor side. So I think to some extent, I think the Philippines is benefiting from that corridor. It's similar to how Singapore has that similar set of corridor where Singapore has a strong diaspora in America, as well as the English proficiency. But I think, I think Indonesia definitely in 2025 has been trickier for sure because of that deflation of the prior big hopes that people had in 2021 and 2022 for Indonesia. And as well as, like you said, E-Fishery didn't help as well for that as well. On that note, is there, to wrap things up, anything that you're looking forward to?
Yeah, I think there's, at least for me personally, there's a lot of deals in the pipeline.
Yeah.
And so it doesn't feel like recent events have, certainly no investor to my knowledge has actually walked away from a term sheet that they've already entered into. Right. I don't think it's gotten to the point where it was a completely different case. For example, February 2020 when COVID hit, right? Like term sheets were actually being withdrawn. Like rounds were not closing. The environment we're in today is not at that level. People are going to be cautious, which they should be, but they're not at a point where they're saying, hey, we're going to close the checkbooks and we're going to wait 4 years to see what happens. So companies are reaching the ends of their cash runways. They're going to need funding. These are companies that I think a lot of investors have conviction in. And I don't think the staring contest to wait for a down round is going to be as pronounced as it was, for example, back in 23. Founders existing investors are willing to take that markdown nowadays, from what I've seen. There's not as much stigma attached to it, I think, as there was 2 years ago. So at least in that sense, I think that the gridlock, this kind of staring contest between VCs and founders is getting progressively better in a very noticeable way. There are ways to solve for a disparity in valuation that I think in 23 and 24, people were still exploring, hey, are these very viable paths, right? Pay to plays, pulling up existing lit pref equity, playing around with conversion prices. If KPIs aren't satisfied, you're effectively repricing prior rounds. There were a lot of things that were being tested the last couple of years that I think investors have now actually gotten quite comfortable with using as almost like a tool right out of the gate. And so if a company needs money, there are options available.
Yeah.
It's just what level of pain are you willing to take?
Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.